Shell dropped 4.4% on Monday as the U.S.-Iran ceasefire sent Brent crude down 5% to 83. That looks like a routine oil price correlation, except for what Shell was doing the same week. In April, Shell agreed to acquire ARC Resources for $16.4 billion, its largest deal since BG Group in 2016, and paused its $3 billion quarterly buyback ahead of ARC's July 14th shareholder vote. It simultaneously began the sale of its offshore wind farms, a $1 billion-plus process run by Rothschild and PJT, completing a pivot away from renewables. The pattern is deliberate. Shell, under CEO Wael Sawan, has been exiting clean energy and doubling into oil and gas. Oil prices had surged 40% since Iran's Strait of Hormuz blockade began in late February, and that war premium embedded in Shell's share price unwound in a single session. Capital that had rotated into Shell as an energy crisis beneficiary rotated out into airlines, miners, and travel stocks. Shell and BP's combined decline dragged the FTSE 100 into the red despite broad market strength. The harder question is whether falling oil is bad for Shell specifically, or bad for Shell's strategic thesis, and those are not the same thing.
Shell's ARC acquisition is not an opportunistic deal. It is a structural commitment to a specific energy demand view. ARC's output is 60% natural gas and 40% oil liquids, and its fields sit adjacent to Shell's existing Canadian assets, which feed directly into the LNG Canada facility. Shell owns a 40% stake in LNG Canada, a plant whose output reaches Asian buyers faster than most competing North American LNG projects. The acquisition logic depends on Asian LNG demand holding at levels that justify long-cycle capital, a decade-plus commitment priced in at today's terms. Here is the buried assumption. Shell's strategic pivot away from renewables and towards O&G was built on an energy security argument. The blockade of the Strait of Hormuz proved, so the argument ran, that fossil fuels from reliable geographies command a structural premium. Canada, politically stable, pipelines intact, tariff-friendly under Carney, was the answer. That argument made sense when Brent was at $120. At $83, the energy security premium has been de-risked by a peace deal whose permanence is itself uncertain. Iran's parliamentary speaker already accused the U.S. of violating ceasefire terms on the day the deal was announced. A Bundesbank official warned energy markets could take months to normalize even if the strait reopens. This is the tension the consensus reading misses. Shell's case for long-cycle O&G investment does not depend on the spot oil price. It depends on whether Asian LNG demand is structurally high over a 20-year horizon. Spot Brent falling to 83 doesn't answer that question, but it does complicate Shell's cash flow over the next 12 to 18 months, which is exactly when it needs to fund an $8.20 cash per share payment to ARC shareholders and absorb ARC's capital requirements. In May, Shell already cut its quarterly buyback from $3.5 billion to $3 billion to preserve balance sheet flexibility after war-related disruptions raised its debt. If Brent settles at $83 rather than recovering towards $100, Shell's ability to restore that buyback and maintain the 40–50% cash flow return it has promised shareholders for 18 consecutive quarters comes under pressure. The verification checkpoint is July 14th. ARC shareholder vote requires 66% support. If the deal passes, Shell inherit 1.5 million acres of Montney shale, adding 370,000 barrels per day of production and 2 billion barrels of reserves. If Brent is still at 83 or lower on July 14th, the market will be asking whether those reserves were priced in at $100 oil, not 83. The leaning is that Shell's strategic direction is structurally sound. LNG Canada and Montney are long-duration assets whose value is not determined by this week's spot price. But the position is only defensible if the ARC vote passes cleanly and Brent stabilizes above $80, which is the level at which Shell's stated capital return commitments remain fundable. If Brent falls below $80 and the ARC deal encounters shareholder resistance, the thesis breaks, not because Shell's O&G pivot was wrong directionally, but because the timing created a gap between the acquisition price and the commodity environment that closes it. Watch the $80 Brent floor and the July 14th vote, not Monday's negative 4.4%. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.